Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are going to be talking about the markets. We are approaching the end of calendar year 2023. It has been another exciting year. Perhaps it was a very volatile year last time. This year, again, basically, we have seen a lot of movements, at least for the emerging markets. We've also seen a lot of rate increases in the developed markets. Correspondingly, emerging markets, central banks, they actually had to follow the course, and we have also seen sort of variation from the perspective of performance of emerging markets. And now the question comes, what really holds now for us for the last 2 months at least for this calendar year, and how actually should we really prepare ourselves for calendar year 2024, at least the first half, how actually overall the markets are looking like. Dollar, which has been on the tear from the perspective of strength, driven by the rate increase by Fed, how perhaps that outlook is looking like. Also from the perspective overall, how the commodity and markets could be influencing the markets. A lot of questions we have. So let's try and decode all of that. Let me now welcome our guest today, Mr. Jeffrey Dennis, an industry veteran, a person who has seen many cycles of the global markets. He is now an independent emerging markets commentator, an expert on emerging markets. Mr. Jeffrey, welcome to the show. It has been always a pleasure to have you on the show.
Thank you.
My first question to you would be, how are you reading the markets right now? If I look at the euro dollar, we are almost actually right now on, breaking new lows for the euro. Dollar has been consistently showing strength. We still don't know whether the rate increase by Fed is really over. So how are you looking at the US data, the US economy, and the dollar strength?
Right. Well, the first thing to say is we've had a very nice rally in equities over the last few days, this week, in fact. And this is very important for your question that you've posed, which is also led, by the way, over the last few days to a nice rebound in emerging markets, a modest rebound, to be fair. What's happening at the moment, as far as I can see, is that there's now much stronger evidence, I think, that US bond yields have peaked at around the 5% level. We've had a very nice rally in US bonds over the last few days, driven, I think, mainly by two things. Number one, driven by a quarterly refunding announcement by the US government, which was a little bit more biased towards the short end of the curve rather than the long end of the curve. Of course, as you will know very well, the US has got a massive fiscal deficit to finance, so that's an issue perhaps we should talk about down the road. But the other thing is that we actually got, with all of this activity this week, the Fed announcement, etc., the refunding announcement, we had a piece of data that was very soft, and that was the US ISM index for October, the first data point for October. And those two things combined, plus I think a slightly more dovish Fed to bring bond yields sharply lower. Investors are now pretty convinced that the Fed is almost certainly finished with its tightening. My view has been for some time we're either at the peak or we're very close to the peak. My guess is we probably are at the peak of interest rates. And all of that has provided a better environment for risk assets. And also it started to bring the dollar slightly lower. The dollar trade weighted index is down about 1% over the last month after some extremely strong performance. So all of that is good for risk assets. It's good for emerging markets. The challenge is going to be what happens to the US data going forward. And of course, how quickly inflation will start to drop again, and how quickly we can get it back heading towards 2% in the US.
I'm curious to ask you, will a stronger GDP growth data along with a moderating inflation, will that be a reality? Because the recent GDP growth data of US was also very strong.
Yeah, I mean, I think you have to view the GDP number for Q3, 4.9%, I think it was, as history. It's past history. It's gone. People are going to focus now on October data as it starts to come through. As I say, we've only really had one piece of data for October, and it was very soft, the ISM index. And so people are going to watch very carefully what happens to that data as we go through the fourth quarter. there is now a lot of anecdotal evidence that the business sector, the investment sector, if you like, is beginning to slow in the US. At least, as I say, it's anecdotal evidence. And there's also a lot of anecdotal evidence about consumers beginning to run down this massive pool of savings that they built up during the pandemic, partly, of course, because of government handouts. On the inflation front, inflation, and I said this at the time, the 3.0% inflation rate we had in June has been the low for the year. And I said it would be the low for the year because the comparables with a year ago started to get tougher. Now, we're now at 3.6, 3.7. I think it comes down a little bit more over the next couple of months to year end. And then you get a more significant drop in inflation, I believe, as you head towards mid 2024 and the second half of 2024 as well. So I think the good thing about the inflation numbers is it may take a fair time to get down towards the 2% level that the Fed's target is, but we're heading in that direction. I think that's very, very important. So I think if you put it all together, the risk is still there that although it looks like a soft landing right now because you've had good economic data and some significant easing of inflation from the peak, we're going to be watching the real economy very closely because, as I say, of some anecdotal evidence that the thing may be weakening now. And of course, this in turn is contributing to, I think, a slightly more dovish set of comments from Fed Chair Powell on Wednesday.
Right, sir. And according to you, what it implies really for the emerging markets trajectory, because of late we have seen the emerging markets actually have been under pressure from the perspective flows, fund flows. What it really implies now for institutions, for emerging markets, MSCI emerging markets, how the sort of allocation could be shaping up?
It's been a very strange year because when developed markets rise, which they've done this year by around 9%, emerging markets usually outperform, usually go up and do better than developed. And they haven't done that. EM is down as of this morning, where the index is again up in Asia today. EM is up, is down about 1.5%. So the major reason for that is because of what's happened in the index to the biggest market of all, which is China, which is still about 30% of the EM index. China is down around 12% this year. Now, when I put my note out about 10 days ago about EM and what emerging markets needed to rally from a very, very oversold level, and it has rallied over the last 10 days since I put that note out, you needed four things. First of all, you needed China to turn around. China may be turning around in terms of its market. It's certainly very underowned. It's certainly quite cheap by Chinese standards, although the economy remains very, very hard to predict and generally fairly soft. You need to have bond yields peak and real evidence the Fed is finished tightening. We've discussed that already. I think that's in now. You need a weaker dollar. Now, the dollar's come back a little bit, but you need to see the dollar going substantially lower, I think, over the next 3-6 months or so to really get the emerging markets moving. And I think you can't deny the fact that a drastic and very dangerous and very, very sad geopolitical situation in the Middle East is the sort of thing that pushes people away from EM and into more defensive assets, even though the impact on oil has been quite limited. So I think the other thing that would help investors to get a bit more aggressive in terms of emerging markets would be some sign that the Middle East is quietening down. And frankly, it's hard to see that happening short term. I'm not a political analyst. I wouldn't know if that's going to happen. But for me, the most important thing is what we've discussed already. We need bond yields lower still. We need the Fed to definitely have finished its tightening program. And above all, we need to see the dollar weakening. What that will do, that combination will do, is it will support emerging market currencies. It will allow some of these emerging market central banks, which have got very high real interest rates now, to start to bring those interest rates down. And that's the sort of thing that will bring the flows back to EM. I think that's what's going to happen. I believe by year end, EM will be well back into positive territory, somewhere between 0 and 5%. We're down, as I say, about 1.5% of the year now. but it still has been a very, very disappointing year. And frankly, the major reason for that is because of China.
China. But markets like India, what's your opinion? India has been able to register positive growth, though we can't compare to Greece. But from the perspective of Taiwan, India, these markets have done reasonably well.
Yeah.
Uh, what's your own sense of the Indian markets? What's the perception? How the markets looking to you?
It's very interesting because, as my note said, if you look at the top five markets, which account for 77% of the EM index, that was as of the end of September. The only one that's down is China. Now, the others are not up very much. They're all up in single digits: Taiwan, Korea, India, and Brazil. So, as I say, the drag has really been China. Now, India's therefore outperformed. It's up around 4.5% in dollar terms this year against, in India, therefore, a substantial outperformance of the index. I am very bullish about India in the long term. I mean, there are the usual challenges in India, which are, first of all, of course, relatively high valuations compared to other emerging markets, although, frankly, not particularly high valuations, I don't think, historically in India, or at least we're not wildly overvalued compared to history. Number two, the big macro challenge in India for some time has, of course, been the size of the budget deficit, and that needs to be something which investors have to keep an eye on. We've got the election, of course, coming up in 2024, which will, I think, be interesting, although one's got to believe at this distance that it'll be business as usual with the BJP winning, and that will therefore lead to continuity of policies, both monetary and fiscal policy. But the other thing I think that has probably slowed India down in the last few weeks, and is obviously something we always have to watch with India, is the rise in the oil price. Now, oil, as I say, has not particularly reacted that much to these terrible events in the Middle East. But, we're looking at Brent between 85 and 90. That's a fairly high oil price. And of course, India importing essentially all its oil is impacted greatly by that. So I think you need to see the oil price coming off, or at least you need to see some sense of stability in the oil price and less geopolitical risk for the oil price before flows also start to come back to India in size. But I still think the long-term India story is very, very attractive. The long-term growth rate of the economy, and I'm never all that bothered about valuations in India because generally corporate earnings are good. But those are some of the factors that are affecting the market in India now. But I would be overweight India right now in a global emerging market portfolio.
And now I'm reading and recollecting what you have said. So we are having a premise where we're expecting a sort of rebound in the emerging markets by the end of calendar year 2023. We are also bullish on India, but overall from the context of emerging markets, are there any particular sectors apart from the top few index where you think perhaps the interest of the institutions should remain high?
I think institutions will remain very interested in banks. That makes perfect sense because banks are at the cheap end of the market spectrum. I think if you continue to see further declines in U.S. bond yields, perhaps we can return to that because there are some risks attached to that. But if we were to see further declines in significant declines in bond yields, say the 10-year yield in the U.S. goes back towards 4%, which I think is possible over the next few months. That's going to really support some of these expensive growth stocks across emerging markets, including India, such as technology, such as pharma, such as consumer. I think where I'd be very wary about being aggressively exposed is in the deep cyclical sectors that are impacted by the world economy, because there is clearly a risk here that the U.S. economy may be about to slow quite sharply over the next few months. I'm not saying that will happen. I think that's a possibility. And with China being quite weak, I think one's got to be very careful about things like materials, and of course, subject to the Middle East, about oil and energy generally. So I'd be looking at the growth stocks in particular, not so much the defensive ones, but the more aggressive ones. And also, if interest rates can come down a bit more in India going forward, that's going to help the banks. And I think the banks look pretty good in this environment as well. One caveat to all of this, one thing I think we need to watch very carefully, is what's happened in the US bond market over the last 2 or 3 months is investors have suddenly decided to worry a lot more, and they should do, about the size of the US budget deficit and the amount of debt that has to be sold by the US government. And of course, at the same time as the Fed is doing quantitative tightening by running off some debt from its own balance sheet. So supply issues on the bond market remain important, or are very important now, which does mean that I think bond yields go lower from here, but I don't think they go massively lower. I don't think we're going to go back to 3% bond yields. I think we're going to settle over the next few months at somewhere between 4 and 4.5% would be my bet, which will give us a bit more impetus in the markets, but will not lead to will not lead to a massive rally in risk assets over the next 6 to 12 months.
Okay, that's interesting. And also, I think one point should be very interesting for our viewers also. If you're bullish on banks, and if you like India, banks actually constitute 40% of the Indian index.
Correct.
So that is something which is going to be very interesting. Then also IT stocks, technology stocks, they constitute a very large portion. So I think that is also something which is going to be very interesting. But moving from there, what's your own sense from the perspective of commodity prices? Are we at the top end now? Because if I link to your premise, perhaps we would be somewhere near the top now.
I think we probably are somewhere near the top. I mean, I'll separate oil out because oil is so subject to geopolitical risk. There was a wonderful article in the Financial Times in the UK 24 hours ago arguing the different scenarios for how the current geopolitical situation in the Middle East could explode into something much, much bigger. And one of those could be, for example, Iran deciding to block the Straits of Hormuz, which would reduce oil exports from the Middle East to the rest of the world to virtually nothing. So there's clearly disruption that could occur in the oil market that could send oil prices much higher than they are today. So that's a caveat. And of course, if that were to be the case, all bets would be off because that would be very negative for the global economy generally. I think with the other commodities, short of there being a sudden and frankly unexpected reacceleration of the Chinese economy, I think things like copper and iron ore and those various metals markets, which are very sensitive to the global economic cycle, probably have got more downside here than upside. And so I think that generally ex oil, I think the risk here is for lower commodity prices, which will of course benefit so many emerging markets, not just India, but Korea and Taiwan, and one or two of the smaller European markets like Central Europe and also Turkey, of course. So there's plenty of room for markets to do well should commodity prices come off a little bit more. And I think that's what's going to happen, excluding oil, which is it's just very hard to call right now, because I think the global economic cycle is slowing down now, and I think the US is going to be part of that.
Well, that's interesting. Perhaps I think we'll keep tracking on that. Also, one question which I think every time Indian investors sitting here, they always wonder about the global institutions. Is that this time how the December is going to look like? Is it something where the investors or the institutions will lap up the emerging market equities, or it's going to be a sort of stay away towards the year end?
No, I think I think they're going to lap up emerging market equities, to use your expression. Basically November through April, November the 1st to April the 30th has traditionally been the most positive seasonal part of the year for markets, including for emerging markets. So some of the expressions: India rally, Santa Claus rally, sell in May and go away. Doesn't work this year, but it's worked very, very well this year, given the last 3 months, August, September, October, have been very poor. So seasonally, I think this is a very good time of year. So if these somewhat better macro backdrop here, which of course, as I say, is real signs the Fed is finished, bond yields coming off the top, dollar being weaker, if they persist, which I think they will for a period of time, that is going to bring investors back to the market. Because what the end year rally is all about, or the Santa Claus rally is all about, is investors positioning themselves for the new year, wanting to get exposed for the new year and the direction they think the new year is going. And so my bet is that 2024 is we're going to have a good start to 24. Mind you, we had a good start to 2023. And I think the seasonal impact is going to really start to kick in now, which is very typical for this time of year.
Very nice, very important to know. And one question perhaps I wanted to ask. We've talked about the Indian markets, we've talked about commodities, the US markets, the global markets. Perhaps one commodity which is interesting. Intentionally, I'm asking you because here our viewers, our Indian investors are near Diwali. They actually love precious metals. And gold has been sort of seen as a safe haven, at least this year, when the times were tough or geopolitical tensions were high. But still, we could not see a very sharp rally in the dollar terms. How are you looking at the gold for now?
I think there are a couple of factors that will support the gold price. One is the fall in the dollar itself, which is the translation effect into the dollar gold price. But secondly, the geopolitical tensions in the Middle East, which if they exploded further, would undoubtedly bring money into gold. But aside from those two factors, I think this is not necessarily a particularly good environment for gold. Inflation's coming down. Investors are putting on risk assets suddenly again. And so, you got to balance those factors out. I would not be overweight gold at this point in time, unless, you really, really do believe that, and that's not my call. I can't make that call, unless you really do believe the geopolitical situation in the Middle East is going to blow up. And I think gold's had a decent run recently. I would be very cautious about being aggressively positive about the gold price right now.
That's an important point, I think, for our viewers. We actually are expecting, we're not expecting any strength, major strength in the gold, I think, over the next 4 or 5 months is the word coming from Mr. Jeffrey. Mr. Jeffrey, last question for our show. From the perspective of the Indian data, if you have seen, are you expecting any sort of major strong outperformance in 2024 versus 2023 for India? Though I note that you have already said that it's one of your favorite markets, but 2024, do you foresee a stronger year versus the current year?
Yes, I do think it'll be stronger. First of all, the bar's pretty low. India's only up about 4.5% in dollar terms. But I think the key thing here is that the macro environment, unless we go into a deep recession globally, which I doubt we will, and if there is a US recession, it'll be short, I think, and rather shallow. I think the macro environment generally will be better. Interest rates will be down, bond yields will be down. There'll be a lot of conversation as we head into 2024 about when the Fed will start to cut rates, which I think is probably going to be sometime in the second half of 2024. The dollar will be weaker. We're coming off a difficult year in 2023. So I fully expect to see 24 to be a better year for emerging markets. And I think India will be a major contributor to that performance. With, I guess, the issues specifically in India is where does the oil price go? Will inflation come down materially further? And of course, is there going to be uncertainty surrounding the election? So within the general context of what I think emerging markets will do in 2024, I think India will do well, and I think it'll do better than it's done in 2023.
Well, elections actually definitely remain the wild card. But on that positive note, for the Indian investors, I think we'd like to thank you for coming on the show and giving us all your insights. And in advance, though we'll again like to talk to you before the year end, but in advance, we'll also actually like to give you a good wishes for a good year ending.
Thank you very much. Thank you.
And dear viewers, hope you enjoyed it. This conversation for now, it's a wrap.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.